Good evening. We welcome you all to this monthly webinar of Almus. It is the episode 5 of season 2 of webinar that we are conducting. Just for your introduction, I am Jayaram Krishnamurthy, co-founder and head of research and advisory at Almus Risk Consulting, the company which is engaged in managing financial risks of currency, commodity, and interest rates for corporates. So while we also, become aggregator of a lot of research and which we keep sharing with the clients on an ongoing basis. But apart from our, daily sharing on a periodical sharing, we also conduct this webinar where we focus on topic of ongoing interest, which impacts the business, economy, etc. So that's where this webinar becomes relevant. And the topic for today is something that everyone is connected with, be there in financial markets or otherwise. Today's buzzwords are actually inflation, recession, and monetary policy. And we are at a juncture in the economic cycle in most economies where rates are coming down or in the process of coming down. But the key question is whether this is in response to moderating inflation or to avert an imminent economic recession. So some major central banks have already eased policy as inflation has hit or close to hitting the target, but Fed has held back as they are still some distance away. And to use their own words, they still do not have the full confidence of hitting the target of 2% target sustainably. Now, recent weak employment and manufacturing and housing has strengthened the voice of the Dows in the Fed and as well as the market analysts, with many now, pointing to past indicators of recession, like, yield curve inversion, SAM rule on unemployment, and then the drop in part-time jobs, all indicating recessions as per history. Some of the Fed members have also supported a cut in September, pointing to risks of acting too late or too little. So we are now in the cusp of easing cycle by the Fed, who is possibly, tilting the balance in favor of growth while still looking at increasing confidence on hitting the target. We all know that COVID was a very important event after which there was a massive easing in monetary policy, and then within 2 years, inflation from close to 1.5, it went all the way to 9.1% in US. The rates were hiked in just a matter of 2 years from 0.25 to 5.5%. Similarly, rates were hiked in other countries as well. Japan was an exception, who continued with the negative interest rate policy also. I think these developments are actually also linked to the massive money printing that Fed did, along with the fiscal easing that the government did. Apart from that, we also had the supply chain issues after the Ukraine war, which led to huge inflation jump. So that's where the rate stayed for quite some time now. It's more than a year that we are at 5.5% at the Fed funds rate. And, since then, we have seen pockets of slowdown. Housing definitely, because of the high mortgage rates, and the manufacturing slowdown has been there. And in recent months, we have seen slowdown in the job sector as well, unemployment rate hitting the 21-month high of 4.3% as well. So these are the reasons people are looking now. Fed has been behind the curve. Yields are actually at a level where it was just when the last hike was made by the Fed. We have seen a lot of volatility in the yield as well. There have been other factors, like the banking sector issues over, throughout this period. So when the yields hiked and then they came down due to war situation, etc. So now what we are looking to see is whether Fed is now responding to the economic slowdown, or to what extent they're going to respond. We'll have early clues on that tomorrow when Powell speaks at the Jackson Hole Summit. So that's what we are examining. And in the Indian situation, just to give a brief idea, inflation in India also hit a multi-year high at 7.79% in April 22. Rates went up from 4 to 6.5%. It's still there. India stopped hiking much earlier than Fed. and they are likely to keep the rates higher much after the Fed cuts. So that's something that we should be aware of, because Indian inflation remains sticky and the growth is good. So there is no economic reason for India to hike. So India, it did not do any QE as well. So these are the things that we are looking at. And to look at these things, we have two important experts in the field, whom I will introduce. We have Vishweshwar Anantharam, who comes in with a rich background of experience of over 25 years, spread across trading, sales, strategy, and analytics, both on the buy and the sell side. He started his career in trading FX, bonds, and derivatives at Credit Alliance India. Incidentally, he was my colleague there as well. For the first 10 years of his career, he was trading FX, fixed income, and derivatives in Bankum and Citi, among others. The next 10 years, he honed his skills in the institutional macro sales desk and went on to head the FICC macro sales business in the securities division of Goldman Sachs in Asia. 2016, he left Goldman Sachs to set up his macro fund, Vanau Asset Management. He returned to Goldman Sachs in 21 to head their Asia macro strategy. And since 23, he has been on the buy side again, focusing on global macro. Vishy, we are really happy to have you here and get your perspectives on the market. And you are not only analyzing the market, but you are putting your money where it is. And I know you have been a trader as well, so that's where we look to really benefit from your perspectives. Welcome, Vishy. The other eminent speaker that we have is Mrs. Achala Jethmalani, who is a seasoned economist specializing in financial markets and macroeconomic research, currently employed at RBL Bank, Mumbai. With over a decade of experience, her expertise lies in serving institutional investors with a focus on fixed income markets. Achala's adeptness extends beyond numbers. She exhibits a penchant for blending economic theories into everyday life, emphasizing the pursuit of equilibrium between work and personal endeavors. Achala, I'm not sure if Achala has been able to join. There have been some technical issue. Yes, I will be happy to have her share her views in due course as well. Now, without taking any more time, Vishy, let me have your overview on the overall monetary policy, whether we are moving really towards a recession, or to what extent Fed is likely to ease. So these are the big questions that everyone has in their mind. I'm sure you're going to give us a better perspective.
Thanks, Jay, and it's for the warm introduction. And it's a real pleasure for me to share stage with someone who was my earliest mentor in this business. When I started at Credit Lyonnais, I was working with Jay on the trading and learned a lot of the ropes in the business from him in those days, which was also pretty exciting times in terms of Asian financial crisis. And then we'd gone into the tech bubble. And I still remember those days very fondly. So it's a real pleasure for me. So thank you, Jay, for inviting me to this webinar. In order to understand, I mean, Jay has given a very good perspective and summary on, what has got us here. And without trying to repeat it, but to put some synopsis to it so that we understand the response function of central banks going forward, which is the key question right now. Now, what happened during the COVID situation was there was a coordinated global triple assault of monetary policy, fiscal policy, and quantitative policy to tackle something which was a forced slowdown due to a supply shock, which was confused to be a recession. It was not a demand shock, which is a necessary condition for recession. Untold amounts of money was pumped in, which went into the wrong places, multiplied and created more avalanche of liquidity, which is still bubbling over in markets and which is muting the impact of policy. And most importantly, central banks, after they willed it, they were unable to recognize what they created. They were late in recognizing the inflationary pressures. They were late in responding to it. And normally it is very difficult for central banks to catch up when they were so far behind. But because some of it was a supply side shock, as that supply side shock abated, it has provided the central banks with an exit right now. But at one time, and many of the central banks that we used to bankers that we used to interact with during that time, they were pretty scarred by the fact that as to how they missed this whole cycle and how they did not respect their own thresholds. And they were worried about their legacy. In particular, even someone like Powell was very worried about his legacy. Now, it's important to understand that when you've come from that background of being so scarred and you've gotten out of jail, how are you going to react? It's like you've had a big accident. You're not going to come out of it and straight away run a marathon. It's going to take time for you to recuperate, and you're going to nurse those wounds and learn from it. And that is the phase that central banks are in. And the reason I was trying to allude to that was that that might give us a clue of how the central banks are likely to react in the cycle that we have. I think as they react, there are a number of things that they need to keep in mind. One is obviously, apart from the fact that they were really scarred, they don't want to commit the same mistake. They don't mind committing a mistake on being late, but not about being on easing too early, firstly. Secondly, if you look at the global composite mix of policy, monetary policy, fiscal policy, financial conditions, quantitative policies, they are still broadly very loose in totality. Only monetary policy tightened. And that is why, even though rates seem high, they don't seem restrictive. We are growing above trend. We've been calling for a recession for a long time. We won't get it because the composite mix of policy is extremely loose, particularly the fiscal policy. And when fiscal policies are loose, what it means is that debt levels are going to be high. And there has been a significant rise in debt. And that means that when debt levels are high and the fiscal spend continues, there is a natural support for growth. What that does is it pushes the neutral rates, which is the non-inflationary level of rates at which an economy is growing, that goes higher. And the central banks are in the process of assessing as to what is that rate. Obviously, it is not the rate that was pre-COVID, but what is that new level of rate? Just because real rates are high doesn't mean that that rate is also high. The other things that the central banks will have to consider is the dissimilarities of this cycle vis-a-vis previous cycles. Now, people tend to look at similarities of all previous recessions, what all happened. But there are a number of dissimilarities too. And those dissimilarities are the ones that will give them a clue on reacting correctly, because they, I don't think, have the tolerance for making another mistake. And lastly, a lot of the soft indicators, which they were used to relying on as lead indicators, have been absolutely useless. And there is a reason why they have been worthless, is because they are survey-based, they are opinions, they are dispersion indicators. I have never had a high level of faith in it, but in this particular cycle, it has been proved. If you look at PMI indicators 2 years back, you would have felt that we are going to slip into a recession. None of that has actually permeated. Now, given that, that backdrop and how we expect the central banks to respond, my conclusions are that the upcoming cycle, whatever it is, whether it is an easing cycle or if we have to slip back into a hiking cycle, will be fairly muted. It was very easy for them to hike when the rates were very low, or below 2%. And inflation was at 8 and 9. But it's a completely different ballgame when inflation is not meeting their target and just gradually going up and rates are already high. How much do you react? When do you react? Just keeping rates here, is it restrictive enough and doing the job? These are the questions that will come up. So I expect the central banks to be behind the curve either way, be it hiking or cutting, even if we are going to slip into a deflation, and we'll go into what the cycle is likely to be. But without analyzing that, either which way, I think the central banks are going to be slow, late, and behind, which means that we will be pitchforked into a high volatile market regime. And the markets will bear the burden of what the central banks are likely to do slowly. And that's why this question comes up, is the central bank behind the curve? Are they making a mistake? And given the bias of central bank that they're itching to cut, but they can't cut, and they're looking for an opportunity, the equity markets tends to become a store of wealth. We've rallied even through the hiking cycle on the hope of recession and a cut anytime. And now that we are actually getting indications of slowdown and the likelihood of central bank cuts, the markets continue to rally. So those are the factors that that central banks will consider, and that's how I expect things to play out. In terms of, there are a number of burning questions, and so that I don't keep this as a monologue, I'll just allude to them and give you a brief answer to those questions, but we'll go deeper into it as the discussion evolves. Are we heading into a recession or hard landing? My guess is that we are more likely to be soft landing than anything else, and that's got to do with the policy mix that, as I said, is broadly still pretty much loose. Carry trades, have they fully unwound? Not by a country mile. I think these are carry trades that's been built over years, and there are simple metrics to look at what that number is. Those are in trillions of dollars. They are not going to get unwound in a week or a month. They're going to take a long time, and probably people are piling back into those trades again anyway. Has the dollar peaked? I think yes. We'll go into the reasons, but I do think that the dollar has peaked, and we may be in for a period of lower dollar. And lastly, what is China up to? Has the slowdown, are we nearing the end? Have we got a lot more to go? I think it's going to be a lost ticket for China, at least, if not more. I see that it is, just to summarize it in one line, I would say that it is an amplified version of what Japan went through in the 90s, with a lot of similarities to how China's gotten into it, with very similar to how Japan fell into it in the 90s. So we could be in for a long haul on China. So those are the brief points that I'll make, and I'll hand it back to Jay for taking things forward.
So Vishy, thank you very much for that opening remarks and perspective. So what I'm getting from you is that recession is less likely, and also Fed will probably take more risks on delaying their action on the either side, be it a cut or and because we already have seen a lot of what can we say, and hindsight may be mistakes. We know that initially they said inflation is transitory, and then they said average inflation targeting, all that, and then we were we went all the way to 5.5 from 0.25. And then when the market is asking for a cut or thinks that there are reasons enough to cut, Fed is actually saying that we need more confidence. So it's there on the other side now. So so I think do you think is it the same approach from the other central banks as well, or is it only the Fed who is in this mode?
I think the Fed is in a trickier situation because of the US exceptionalism. And that US exceptionalism is due to, as I said, any country, when you look at the impact on the economy, you have to we tend to look only at monetary policy. But what happens in an economy is a sum total of monetary policy, fiscal policy, quantitative policy, foreign exchange policy in terms of the US, and financial conditions. And why financial conditions? Because the mix of the four policies impacts financial conditions, which is nothing but the health of the asset markets. The asset markets, if they are very healthy, and to give you just one number, the post-COVID, pre-COVID high of the market capitalization of the world equity markets was $80 trillion. We are at $120 trillion. So we've had $40 trillion of additional wealth, and it's probably higher. It's probably more than this now. I think probably close to 127. We've had almost $50 trillion of wealth that is created. Now, no matter what, and people keep obsessing with excess savings in the US having gone down and credit card debt going up, the amount of net worth increase, the cumulative net worth of households in the US is almost 8 times of GDP. 8 times US GDP, which is 26 trillion. The last I looked at that number was about 155 trillion. Okay? And if we just take deposits and money in checking accounts and balances, even those are in the $7-8 trillion equivalent. Credit card debt is about $1 trillion. So the health of the consumer is extremely strong. Never mind, what people might obsess with, small increase in bankruptcies on credit cards and savings being eroded, and but the stock. So there's a flow in the stock. The flow is bad because of inflation, so the savings rate is going down. But the stock is the net worth and the savings as a whole. That is very, very sound. Household debt is at the lowest ever in terms in a long time, almost 30-40 years. It's been the lowest. Household debt obligation, as in terms of annually what they pay, because most of the mortgage is the biggest form of debt, and most of the mortgages were fixed rate debt, which they so 80% of US mortgages, which is almost 11 to 12 trillion dollars, 80% of that is fixed rate. So effective mortgage rate is 3.5% or 3.7%, when the actual mortgage rate is close to 6.5%. So the consumer has not felt anything. So the transmission of monetary policy has not happened, and your wealth has increased, which is what I mean by financial conditions, and fiscal policies remain easy. Similarly, if you look at corporates, interest burden of the corporates has actually gone down in this cycle when interest rates have gone up, because the cash balances of corporates are so high that, and this is, I'm talking about the entire universe. Obviously, there would be corporates on the lower end of the spectrum and the higher end of the spectrum, but overall, corporate interest burden has gone down. So if corporates and households, there are three segments to an economy: corporates, households, government. And then there is net exports. The three out of the three segments, two segments are extremely strong. They make up more than 60 to 70% of the economy. How do we expect that economy will slip into a recession? Sure, we will see a slowdown. We've seen a slowdown, and we should not confuse that slowdown to be a recession. For example, people have been jumping up and down with claims going up to 225,000. If you go back to a steady state trajectory of claims pre-COVID, which was an uncontaminated time, it was 265,000. So we are 40,000 below that when the labor force has actually gone up. If we look at unemployment rate, at that time it was between 4 and 5.5%. We are at 4.3. People are obsessing with this SAM rule, which is nothing but a momentum indicator on itself. It is like saying Nvidia stock will go up to 15% once it goes, when the moving average of that stock, 3-month moving average of the stock, rises from the bottom by 5%. It's not an economic rule by any stretch of imagination. It has been overcooked in the markets. People have overcooked the inversion of the curve. The inversion of the curve has got to do with the Fed doing so much of QE on the back end. So if anything, the mispricing is in the back end. And that caused inflation. So front end had to be high. So naturally the curve will be inverted. It's not a signal on recession, but people have been putting that as these are the things they put in their recession indicator, and they say, oh, recession. Since June 22, I have had these recession calls thrown at me, and I have consistently maintained and written various, made various presentations identifying 10 reasons why I don't think the US will go into a recession. It's 28 months on, and I'm hearing the same noise, and I'm of the same opinion that it is. I'm not saying there won't be a slowdown, but recession is 2 successive quarters of below zero growth. You are a far cry from it. We are actually growing above trend even now. The GDP, nowcast GDP is running at 2.5%. So yeah.
Got it, Rishi. Yeah, thanks for that explanation. Welcome, Achala. I think we missed you in the first few minutes, and I've already introduced you to the audience. And I made a few points on the Indian scenario. I don't know whether you were able to hear that. For your benefit, I can just recount that. COVID effect on India was, inflation hitting 7.79% in April 20, the highest since May 2014. India rates hiked by 2.5% in this whole cycle. India hiking stopped much earlier than Fed, and they probably will hold these rates much after Fed starts cutting. So Indian inflation remains sticky at 5%, and growth is still high. There seems to be no major economic reasons for Mr. Das to cut the rates early. So this is the background I set for India. I would like to hear your perspectives on India in the background of what's happening globally. Thank you.
Thanks, Mr. Jayaram. Hello, Mr. Vishweshwar. Hello, everybody. My apologies. Firstly, I could not join in time. I was facing some login issues, but thanks for having me here. Great points made by Mr. Vishweshwar. Similarly, for India also, when we talk about the growth momentum, it is still quite positive. It is being supported by a lot of policy steps that the government has taken over the last several years, including its own capital spending, infrastructure related spending, which has given it a positive momentum in itself. Of course, there is a lot of noise around consumption slowing down. Rural consumption is still fragile. Household savings have dipped. There are all those points as well. But overall, when we look at the growth momentum, it is still quite positive. And the even bigger positive from that is that it is supply side measures that have contributed to it. So even if we look at it from a 3 to 4 quarter perspective, since there has been so much done in the infrastructure segment in terms of investments, we could see that would give it a positive momentum going forward as well. So although we will see growth rates coming down from 8.2% seen in FY24 to say just about 7% this year, but on a sequential basis, still the economy is holding up pretty well. Now, coming to the inflation aspect of it, a lot of it is because of supply side aspects, such as it's lately been driven by food inflation, in particular last 6 months. There is, of course, this debate that monetary policy cannot directly control food prices. So why would the RBI maintain such a long pause when demand conditions seem to be softening? Which is true. Some of the consumption indicators in India are showing that consumption is slowing down. People are prioritizing where to spend because inflation has been high, which has given there's a concern around disposable income, there's concern around taxation, etc. But so the talk about food prices not being controlled by RBI, we should pivot to rate cuts, as the Fed also pivots to rate cuts, is something that I don't agree with. I have a slightly different take because, as you rightly mentioned, India did pivot to rate hikes immediately after US started raising rates. But of course, India did not raise as aggressively as the states. We went from, say, 4 to 6.5% in overall rate hike trajectory, but US went from 0.5 to, say, 550. So the cut cycle also, when we talk about rate reversal, India may not see as aggressive rate cuts as US would start when it start cutting rates. Now, coming to when will RBI MPC start moving towards rate cuts, whether it would be immediately after Fed, since September seems to be a given. Now, the debate has shifted to 25 basis points or 50 basis points by the Fed. But that would not imply that when the MPC meets in October, we would see it going in for rate cuts as well. There are strong domestic reasons, one being growth momentum is strong and positive. So it does not really need to support growth. Therefore, monetary policy accommodation can wait. Also, it may not take a policy accommodation approach only by policy rate tweaks. It has been doing so by infusing liquidity into the system. We've seen that the banking liquidity has been in surplus since the last policy, which in a way has eased concerns around overall cost of borrowing. The yield curve has been soft as well. So there are different policy steps that can lead to policy accommodation overall. Second is the inflation aspect, which is why we think that they may not be in any sense of hurry to go for rate cuts, because I still stand by the view that if your food basket still comprises of, say, 30 to 40%, even if there was a rejig in consumption basket or food weightage was to be reduced, it may not necessarily lead to a sharp revision in overall weightage of that basket in CPI. So therefore, even if it comprises of, say, 30% of your CPI, that still does not give enough reason for the RBI to move the needle when it comes to rates. Because you can't be having 40% weightage of food, which is running at a run rate of about 8 to 9% for the last 12 months, and say that, oh, there is no inflation worry. Because even when we look at some of the retail sales numbers, we've seen that in the month of July, food and grocery items have seen a higher share of allocation or spending vis-a-vis some of the other discretionary spending. So consumption slowdown is there, but our price stability remains at the helm of when we talk about RBI. They have emphasized on achieving price stability and moving more towards the 4% medium-term target. And until that happens on a durable basis, which is at least for next 2 quarters, once we start moving closer to 4.5% handle. So we expect that the policy pivot to come through in 4th quarter of FY25 rather than end of calendar year 2024.
Thanks for that perspective, Achala. So would you want to put your mouth argument of when RBI will actually cut rate?
February 2025 is where I think the first cut could come through. Okay. But before that, we could see change in stance to neutral, and then also liquidity infusion. As I said, they've been managing liquidity and keeping it well in the surplus. So that would be additional comfort when you look at overall rates, a segment of it. That's also one of the crucial channels for monetary policy transmission. So that would be a gradual pivot to policy accommodation rather than moving the lever on policy rates, say from 6.5% to 6.25%.
Okay. That's great. Thank you. Thank you very much. Vishy, just wanted to, you were saying, Fed is likely to rather delay its action. Now, also, how do you see the policy evolving? Actually, do they have to cut much in the face of huge debt that US government is running, 35 trillion debt, and the fiscal deficit of 6.5%? If rates come down, I think the person who wants the rates to come down most is the US government, because their finance cost is multiple times of their defense budget. That's what we are hearing. So really, do you think there will be a series of rate cuts by the Fed in the face of these deficits, or which of course government will welcome? If at all, I feel it can be more of a political decision than an economic decision, possibly, unless we, sorry to extend this question, because previous big cuts have happened in the face of real recession, GFC in 2008 and the COVID crisis. So what is your perspective on this?
Yeah. So, firstly, I mean, they have not yet abandoned the 2% target. Whenever I should listen to the press conference of Chairman Powell, I would count the number of times he would allude to 2%. Right? There's no need to keep saying we are steadfast on our 2% goal. You could just say that you are focused on your inflation objectives. But the constant, and each time it would be about 8 to 10 times that they would, you can pick up that he will keep alluding to that. And you can pay attention to it even in the next press conference that he has, which tells me that they have not yet abandoned the 2% target. Now, 2% target does not mean that we approach it and kiss it and go back up, which could well be the situation that we may be faced in right now, where we are coming down, but you start going ahead and cutting, and then it turns around, because we've seen how the economy has a very high reaction to the change in the financial conditions. And the financial conditions change, which is markets, ebullience of markets picks up when rate cuts happen. And the change in financial conditions boosts growth with the 1 quarter lag. And, soon again, you are in the same loop where your own actions have actually prevented you from achieving your objective of getting inflation below 2. So that's why I think they will be measured. That does not mean that they will not cut. And the reasons for cutting right now is that probably they are looking at real rates being quite high. And obviously they're looking at providing some relief to the treasury, where the interest burden of the government is almost likely to rise to probably 4% of GDP, which means that doing nothing, you're going to have a 4% deficit. And in the past, if you look at when unemployment rate was this low, the fiscal was either flat or even positive during the Clinton era. We've never had a situation where the fiscal is worsening, even when unemployment rate is so low, which is basically a reflection of strength of the economy. So obviously, in a slowdown and in recession, the fiscal deficit is going to go up further. So it is a challenge for them, and that is the reason that they may be tempted to cut. But they also know that if they one of the reasons why I think it's going to be very difficult for even in the Jackson Hole or for that matter in the next FOMC for them to signal deep cuts means that you are going to cause the market to price more. And that almost acts like a cut. I mean, in January earlier this year, we had a situation where the market priced 7 cuts. Effectively, it became a cut. And the financial conditions reacted to that, turned around quickly, and before the Fed could blink an eye, you had the growth and activity recover. And so I think the communication from the Fed needs to be more clear that this cannot be a deep cutting cycle, even if they embark on cuts right now. If they don't give that signal, the markets are going to behave like this cycle is similar to the previous ones and go and price more. We priced 8 cuts when we had that wall blow up and equity market sell off. The markets have corrected, but the markets are still priced for 7 cuts. So it is imperative for Powell to convey, and Jackson Hole could be interesting, and maybe they use the language around neutral rates being higher than before, and hence, that's a signal that they can't cut that deep. But there is some form of communication that the Fed would need to do if they really want to make sure that the markets don't go through this kind of volatility on the fixed income side that we are seeing. So I mean, I think at best, this cycle at this stage looks like maybe it will be about 75 to 100 basis points. And depending on how the inflation trajectory pans out after that, I just don't feel that the policies of either Trump or Kamala Harris is going to allow the fiscal situation to get better. Both of the policies seem like the fiscal is going to get worse, debt burden is going to increase. And this is happening at a time when there are a lot of countries trying to move away from the US dollar. So they cannot take it for granted that they can finance all of this. And the Fed is still on a QT mode, although the QT is very passive, and it's very different from when they did QE, where they was active and buying duration, whereas it is passive and letting things mature, so there's zero duration impact. But as things mature and you need, and your debt increases and your interest burden also increases, who's going to buy all this debt?
So 2 short questions or 2 short answers I look for. How is Powell going to sound tomorrow? And second question is, how many cuts do you expect this year?
Yeah, I think we put too much emphasis on this payroll revisions and the job market deterioration. I would be very surprised if Powell sounds very dovish, because if he sounds dovish, what is this market going to do? It's already priced for 7. He has to ask himself whether he is likely to, does he see 7 cuts right now? And I don't think the dots don't signify that. I don't think that's going to change significantly in the next SCP either. So the sooner he corrects it, the better. Or there's some form of this forward guidance, which has become forward confusion, needs to be abandoned, because you're only causing more volatility and confusion in the markets with this. So I have a bit of expectation that he might have something to say about neutral rates being higher than before. And that might be a way of saying that I can't cut a lot. But that's a non-consensus view, and that's a very contrarian view. But I certainly would be surprised if he sounds very dovish, especially not due to the payroll revisions, because the unemployment rate does not change from these payroll revisions.
Thanks for that. Achala, will currency be one of the considerations for RBI when they handle the rate aspect? Because rupee is already trading at its weakest level. If, of course, we are not close to a rate cut, but if we do that by, let's say, the last quarter of this year, do you think that will be one of the factors that they will weigh before, acting on the rates?
Yes, I think that has been on everybody's mind, but especially at this policy, we did think that they would give some indication as to what their FX strategy would be. But it is outside of RBI MPC meets where the governor has been a little more vocal by stating that they would be opportunistically building their FX reserves. And that seems to be the strategy. So at least when we look at it in nominal terms, our currency, dollar INR, has not done so well. It has continuously depreciated despite a stronger external sector that we have seen in the last couple of years. The current account deficit is down, balance of payments is in surplus, and yet we've seen currency remain under pressure. Right? So when we look at RBI's strategy, even when we look at the intervention, it has been present on both sides. And
Yes.
it is very hard to tell whether it would be continuously intervening in order to ensure that the currency does not significantly appreciate or depreciate. It has always gradually moved in a very staggered manner. Of course, there's a depreciation bias given that we still run our current account deficit. We've moved close to 1% of deficit to GDP, which is lower than the 2% that we saw in the previous year.
Yes.
But it is still a deficit, right? But despite the inflows, we were anticipating that we could see it move towards 82.5 and not move towards 84. But what has happened in the last 3 to 6 months, despite strong inflows in markets, we've seen it move to 84. And the reasons can be, one, we've seen slightly higher import bill on a monthly basis. So the trade deficit is higher by about $2 to $3 billion in the last 6 months, which is offsetting the positive flows that we've seen, especially on the debt side.
Yeah.
And post the union budget, we've seen that equity outflows have kind of gone up. Although the debt inflow is about $1.5 billion on a monthly basis, especially since the bond index inclusion that came through for India. So at least we see positive flows on the debt market side. And as far as its policy is concerned, whether they would be looking at currency per se, I think that has been an important factor. But I don't think that it would be a repeat of 2013, 2014, where policy rates were literally used as the first line of defense to ensure that there's not much outflow from the country. And given that the Fed would now pivot to rate cuts, I think India as a strategy would look at domestic factors, one, and second, may not follow as closely as what the Fed would possibly do in terms of how many rate cuts can US do and how many rate cuts would India do. If US was to move down by 100 basis points in the next 6 to 12 months, that does not necessarily mean that India would also move by about that much. So as you mentioned in your comments previously, that India did not move even when the Fed hiked by another 50 to 100 basis points. India stayed pat at 6.5%, looking at the India macros story. And therefore, currency will be one aspect. On a nominal basis, the currency has depreciated. It has been largely in sync how EM currencies have performed. In between, dollar index was significantly stronger. It's only now in the last few weeks it has softened because of repricing of rate cut expectations, so on and so forth. But it's not exactly getting reflected in nominal terms. But when we look at it from a real exchange rate perspective, the read aspect of it, we are still seeing appreciation trend when we look at it from, say, a trade-weighted basket, how India is doing with its key trading partners. One important thing to watch out would be for how is Chinese yuan performing.
Yeah.
So at least when it was depreciating, we were moving closely with how China's currency is doing. Now, correlation does not, co-movement does not really mean there's a strong correlation, of course. China has its own domestic reasons, and there's a lot of global concern around its growth. There were capital controls in place. The property market is still in deep pain. All of that, and monetary policy is easing. It's like it's moving in a very different trajectory as of now. When you talk about growth, there's concern around deflation, as Mr. Vishy highlighted, that it could be amplified version of what Japan was some time back, right? So currency, I think it would really look at how other EM currencies are doing, and in terms of the spot rate, it would continue to keep it in a very range-bound manner, so that there is at least this stability that we see in how the currency is moving rather than wild swings. For example, Indonesia announced its policy rate yesterday, and it maintained it at 6.25, citing that
and Korea today also.
That
Yes.
they're still concerned about their currency. So I don't think India is in that kind of situation wherein global factors would influence its monetary policy decision, unless there was a significant shock. Like, for example, when Russia-Ukraine happened, of course, the policy choices were different. But if you were to look at the current backdrop where each economy is responding to their own domestic developments rather than any global shocks, then we could still have some more independency and leeway and account for growth inflation aspects more than the currency volatility aspects into policy making.
Yeah, I get that. Really, thank you very much. Vishy, just to move away from US, we focused a lot on US. July 31st, we had two big things. One, unemployment rate shot up to 4.3%. Everybody talked about recession in the US. Then on the same day, a few hours earlier, Japan hiked policy rate, to 0.25%. They have hiked their rate after 17 years. So that led to a lot of turbulence in the market. We saw a lot of, unwind. So do you think there are more hikes on the way from Japan, and how it would impact the markets?
I think they showed their weak hand by responding to the market reaction post their hike. Although the markets took it quite okay when they actually announced the hike in the press conference, when the governor sounded that he's just getting started and that things have got a long way to go. That really panicked the markets. And that's not surprising, because for years this carry trade has built up, right? And the best way to estimate this carry trade is, and Deutsche Bank did a very good piece on that, was to look at the balance sheet of BOJ and GPIF and all the domestic banks, and the size from that, which is fair because they are the ones who are creating the primary source of money, and the banks are then multiplying it. That number is close to $20 trillion, right? And that has gone into every possible asset in the world, whether it is a Mexican versus a Mexican cross, or whether it is a Bitcoin, whether it is US treasuries, whether it is real estate, wherever. So the question about whether the carry trade unwind is done or not, there is no way that it is done. It's got a long, long way to unwind. But how does Japan, does Japan have the gumption to keep doing this? Maybe the timing is absolutely appropriate for them in terms of US cycle peaking and coming off, which is what they've been waiting for. So it only gives them, it puts less pressure on them. And hopefully, even as the inflation in the world, and Japan has been slightly lagged in the whole inflation cycle, hopefully as they embark on it, inflation in Japan also starts to moderate. But I think even if they don't hike, I think the bigger thing in Japan is not the hikes, but the quantitative policy. And right now they've kept it open, saying that they don't want to give any levels, but they'll be there. But the BOJ owns 146% of GDP equivalent of bonds. That is almost $7.5 trillion. If you don't, even if you don't buy for a few months, the market's going to be really weighed down by by how you're going to manage that supply that comes in a market where you've been absorbing everything all these years. To answer your question, I don't think they have the gumption to do a lot on policy rate. They would like to get to 1%, but they may probably go in alternate meetings and slowly get there. But they have to do the balance sheet normalization. And by normalization, I mean just don't buy anymore and passively and run off a bit. That itself will be a very big impact. Not buying is equivalent of a QT for Japan because of the fact that they own so much. And that has a bigger impact on the market. And the other thing related to it is that as the dollar has peaks and if the Fed is really going to start signaling cuts, whether the correction in dollar yen is going to trigger more of a carry trade unwind simply because the yen is going to come off. One side of the trade is whether you're funding it cheap or not. The bulk of the gain was coming from the yen weakening. Now, if the yen starts appreciating, and we already appreciated more than 10% from the worst levels, if we appreciate another 7-8%, I mean, we could have the carry trade unwind continue even without BOJ doing too much.
That's true. Yeah, I think I was about to point out that to you. Yes. So since you touched upon the currency, now you think you also earlier mentioned that probably we have seen the top in the dollar. So is it a structural move that you are expecting in the dollar, or is it a cyclical down move of 5 to 10% that you are seeing? Because there is a lot of talk about diversification from dollar, gold has been gaining, all that. So what's your perspective on that?
I think all the headwinds are there for the dollar. I mean, one is the policy rate and the rate differential that is coming off. And if we see just at the time when the US embarked in 21, late 21, early 22, I mean, dollar had a big move after that. So we've kind of retraced a lot of that. We will retrace that too, because a lot of the other countries also had. Then you have this diversification that is happening, which is going to be bigger than what we can that people think, because it happens in chunks. It's not a few percentage points. I mean, if a whole block of oil between China and Russia and Saudi Arabia and whatever is all going to be traded bilaterally, there's a big chunk of things that may not be traded in dollar. Now, that alone does not have drive the dollar. I mean, as long as they are priced in dollars and as long as the transactions and settlement or in some form or the past funding related to that happens in dollar, it will still remain a major reserve currency. But from 88% of global transaction in dollar, even if it comes to 70, I think it will have an impact on the dollar. I mean, we had similar situation when sterling was the major currency and sterling lost some of that status, and it did pay the price for it. So I think it's not just a tactical move. And don't forget that if Trump comes in, he pretty much understands the currency game. What Japan and China have been playing all this while. The first thing he's going to do is go after them to appreciate their currency, which is going to be which is going to cause an depreciation of the dollar. So broadly, we have hit we've seen the tops, I think, in dollar for a long time. And I do expect that there could be at least a decent 10-15% correction in the next 6 months.
So we probably go towards 90? 90 or
yeah, and the dollar index, I think Euro could get back to 120 levels, which was the levels before. The Aussie is like way too low. Surely, the China driver is not there. Commodity related is not there. But let's not forget, Aussie, the risk premium of Aussie should be a lot less now because of the fact that they've fiscally tightened a fair bit. They're a budget surplus. Their current account is also reasonably okay. So every reason to believe that most of the other currencies are in a better place. The only question is what happens to the emerging currencies. And we were talking about INR also. I think India needs to really worry about resident conversions. I cannot understand how, in the face of strong FDI, strong portfolio flows on the debt side, not muted equity market outflows, why is the currency weakening? When interest rate when inflation differential has never been as favorable for India as it has been in the last 4 or 5 years, where global inflation was higher than Indian inflation, right, at various times. So if in this time period, India, and when with growth being strong, political stability being there, if all of this is there and Indian INR is not appreciating, and it's actually weakening, RBI is actually still selling dollars broadly, I think resident conversions is what we need to look deeper into to see. Maybe a lot of the Indians are taking money out, using every route to get money out, which is why the INR remains weak. And that is a story in many of the emerging countries. The Brazilian real remains weak. The Mexican peso was the only one that was doing very well, benefiting from the shift of trade from China to Mexico from US side. Even the Mexican peso has got hammered in the last cycle post the elections. And then we spoke about IDR, and Thai baht has political uncertainty. So I don't know how much the emerging currencies benefit from this dollar softening cycle. It looks like more of a DM dollar weakness and DM strength in that period.
So, Achala, picking from what she was saying about INR, I also want to ask you if, if really we have, see, so far I've been thinking that the dollar is still in a range. We still held on to the lows of the year in the dollar index at about 101.20 something. But if you do really see a crash, further crash in the dollar, do you think RBI's policy on the currency will change?
No, I don't think so, because they have been really focusing so much on building its FX reserves. But I don't know where is it going to top. We are already at 11 months of import cover ratio. Our external debt, even if you look at the short-term external debt, it's below 30% of GDP. So there is, as Vishy was saying, if not now, when would have the currency appreciated? Because India seeing a CAD of 1% of GDP with services exports being so strong, what is the reason behind this strategy? Is it because our biggest trading partner from whom we import the most has seen currency weaken? And that's why we are also keeping it weak so that we remain competitive. But if we were to remain competitive, then it is not getting reflected in your read, because inflation dynamics are also turning favorable.
Yes.
So what is it that it is going to drive currency and be much more market determined rather than central bank strategy determined? It's very hard to pinpoint on a very say daily or weekly basis what is the kind of intervention that we are seeing, because you really don't know. It's like a black hole, or a black box. You're not able to identify unless 2 months later whether the RBI was present and if it was on which side. Like for the month of June is the data that we have, and they sold about $2 billion, or rather net purchase of about 2 billion, right? So what is the range? The standard answer we've been listening to or hearing is that they want to ensure that there's limited volatility, but limited volatility and it being so range bound, it's very difficult to understand whether it would continue to appreciate or it would depreciate. It is hard to tell even to some of our clients, whether if they don't have a natural hedge to whatever they're exporting and so on and so forth. So it's a tough call, but I think as of now, at least from the commentary and speeches of the RBI governor, we think that the focus really remains on building FX reserves. We touched 675, we moved down to 670 because they sold, and then probably 700 billion is what looks clearly very visible right now. So I don't think we'll leave it there and say, oh, okay, we have built enough reserves.
Looking at the rate at which it's going up, I think before DAS term ends in December, probably they will hit that.
Yes, at 700.
Yeah, it's not just 700. I think RBI, probably has at least $1 trillion in its sight.
Possible long term.
Because if you open the levers of foreign debt, which was something they were very averse to, and for various reasons they gave into it finally to allow it. And in the past, they were never wanting to do that because they thought that India is fairly vulnerable on FDI, on external debt, on equity portfolio flows from foreigners. They didn't want to add the debt component as well to it. Now that they have done the debt, which means that the offset to that would be that you have to build sufficient amount of reserves. And I don't think 30% of external debt, short-term external debt is all of the count. I mean, the real count is you got to add all your portfolio flows. Even FDI can get hedged, right? Which can even if it doesn't go out, it can get hedged and can put pressure on the currency. So RBI is not going to feel, and they, you know what happened when the last time when currency weakened during COVID, they lost $100 billion, $140 billion in no time. In fact, they lost a fair amount of reserves due to valuation, which was basically losses in non-dollar currencies and in the bonds they had. So I would be very surprised if they get off the horse on accumulating reserves, even if they allow appreciation.
Yes, that's correct. So therefore, the strategy clearly seems that it would be continuing to build FX reserves, and therefore, despite favorable external sector dynamics, you will still see that the currency will still move more towards 84 or stay there rather than move towards 82.5 or 83 for all the possible positive reasons. Also, as Vishi was saying, how everyone is moving away from, every country is moving away and diversifying to other countries. India is really focusing on that with bilateral arrangements and payments. So that also is in a way suggesting that this is how they would want to manage their currency flows or payment flows, at least with some of the trading partners. And I think that is something that one needs to watch out for instead of just focusing on how the dollar and our pair would continue to perform.
Thank you very much. So actually, we have run out of time in the sense we are already overshot by 3 minutes. But we have 2 questions. We'll address that and then we can end this webinar. There's one question, Vishy, probably you can say this: why gold is moving up against a bullish trend based on China changing nature of reserves from previous US Treasury bills buying? What do you foresee as China long-term game?
So the gold move has got to do with central banks accumulating, and that's because a lot of them expanded their balance sheet, debt increased. And, if you go by historical levels, central bank reserve gold coverage to what they, in terms of what their reserves they have, that ratio is way too low. So we are seeing that also in China. People have, there is no avenue for people to manage their wealth. Savings rate in China has gone up by 15%, as in it's gone to, the savings rate is almost 56% of GDP. That's because people are finding, one is their main source of savings was in real estate markets just collapsing. And they don't know whatever they've invested it's going to be worth anything. So they're hunkering down, cutting on spending, and just saving. The equity markets are not there. They don't have interest rates in the banking system is going down. Bond yields are going down. Wealth managing products have been eliminated. What are the Chinese going to do? So it is a big challenge in terms of resident conversions, because China's money supply is 14 times their FX reserves. So if even 5% of their domestic money supply gets recycled out, their FX reserves are going to be cleaned out. So what is the only way is like both the central bank and the domestics are buying gold. And I think that has happened. The broad fundamentals of the gold market. Gold rose even when interest rates were high and real rates were high. So the moment interest rates come down and real rates come down, it's going to only improve it further.
Got it. Yeah, that question was from Vinod D. Silva. I have one last question. Hariharan Srinivasan, will reduction in import of gold has impact on inflation and rate cut? I think this is specific to India. The question is not clear, but I think Achala, you can just deal on how the latest duty cut on gold has impacted. What we can look forward to? There will be more import of gold, or how the industry is going to benefit.
Yeah, just before that, I'll add to what the previous question was. The change in nature of central banks accumulating gold reserves also came after we saw restrictions on Russia for dollar related withdrawals and all of that. So weaponization of dollar, if I was to be bold enough to use those words, is also one of the triggers why it kind of triggered this concern that we really need to diversify. So I guess it kind of backfired to the US when they showed a lot more power in sort of a wrong way. The intervention should have been probably different. But anyway, so that's probably one of the reasons. Now, coming to the question on India importing gold, I don't know whether it would lead to lower inflation, or is it high inflation in India that often tends to increase demand for gold. So I think in order to address the gold import demand, if the country was to do that, the focus should be on price stability. And which is why my emphasis has been that even if everyone on the street is saying, oh, food does not matter, but food matters. When, for example, Bihar, you've seen an inflation rate of about 6%, because Bihar has 60% weightage in its CPI for food. So in the poorer states, it's about the sentiment, right? And it's the rural areas which do not have access or willingness to have financial instrument related savings, but gold or property related investments. So the focus will have to be price stability, and which in turn would mean that probably we will have a lower gold imports and therefore a rate cut, because the only way it would transpire into higher inflation would be because of currency depreciation if your import bill were to be higher. So that would probably be the way forward to go for rate cuts. That would be a better approach rather than focusing on reducing gold imports and then go for rate cut sort of thing. That's my view. Thanks.
Yeah. Yeah, thank you, Achala. Thank you. I think it's been wonderful talking to you guys. I think just to summarize what we got from this conference, rather the webinar, is that we are not seeing a recession in the US. There are no hard indicators towards that. And then we don't see Fed moving too much, too fast. It will be a measured move, if I understand correctly from Vishy. And finally, the dollar has perhaps seen it stop. We could see a move of 10 to 15% in the coming months, probably. And then from the Indian perspective, Achala, I think you have made it clear that RBI is not going to follow any of the global trends in the monetary policy changes. It will have its own individual approach, and possibly you have indicated possibly in February, where you can see a first move from RBI in 2025. As far as the currency is concerned, you don't see the policy changing much, although all justification to let the currency appreciate, but that's not happening because of possible policy of increasing our reserves towards 700 billion and beyond. Thank you very much, guys. I think it's been a wonderful session. We can go on talking about these topics for hours, but I think we need to consider the people who are participating also. So we'll find definitely another session where we can interact more. Thank you, Vishy, and thank you, Achala. It's been wonderful talking to you guys.
Thank you, Jay.
And thank you, Jaya. Thank you,
Thank you.
Thanks, everybody.
Thank you.